Welcome to the 3-Edge Weekend Review for the week of May 26th. I'm Fritz Folts, the Chief Investment Strategist here at 3-Edge, and joining me here once again today is Steve Cucchiaro, CEO and Chief Investment Officer here at 3-Edge Asset Management. And although investors tend to focus more on equity markets and high-profile stocks such as NVIDIA, today Steve and I are going to discuss the recent action in the global bond market, which may have the potential to derail the equity market in the months ahead. And basically, what we are seeing recently is investors demanding higher yields to buy longer maturity government bonds. And this is not only happening in the US, but also in Japan, the UK, and Germany. One way to describe the situation, since April 2nd, when we heard the Liberation Day tariffs announced, is that the U.S. equity markets and the Treasury Bond market are somewhat in disagreement here. Although bond prices have recovered somewhat over the course of the past few days, since April 2nd, in round numbers, the S&P is up approximately 5%, while the 20-year U.S. Treasury bonds are down around 5%, meaning the yield on 20-year U.S. Treasuries has increased since lower prices on bonds equal higher yields. So let me bring Steve in here to help us try to sort this situation out. So Steve, as I mentioned, usually investors want to talk about the equity markets and the action there, but I think it's important to help our listeners better understand the recent activity in global bonds. So perhaps you could begin by just describing what seems to be happening, not only in the longer maturities in the U.S. bond market, but also in the markets outside the U.S. in government bonds. So I'll turn it over to you.
Well, Fritz, as Bill Clinton's advisor, James Carville, once said, if there was reincarnation, I could come back as the bond market and intimidate everybody. And as President Trump's own words recently, the bond market is getting yippy. And he said that just before he backed down and delayed tariffs on foreign countries. So the bond market acts as a disciplinarian on governments or corporations when spending relative to income gets out of control, because the bond investors simply require a higher interest rate to compensate for the added inflation and default risk, and that works against the borrowers hoping to borrow at the lowest possible rate. So recently, market analysts have been convinced that bond yields will go down because they see signs of a possible slowdown in the economy. And that absolutely hasn't happened. A lot of these investors have been hurt by that. Instead, bond yields, as you mentioned, have been rising, especially in the longer term, and not just in the U.S. So there are two potential causes, though, in the U.S. One is that there are increased worries about tariff-based inflation, how these tariff policies, even the fear of tariffs, are starting to cause potential inflation. It hasn't showed up in the data yet, but it might starting a month or two from now. Second, foreign governments and investors have been dumping U.S. dollar-based bonds because they have this new fear that U.S. policy is becoming very chaotic, that the U.S. is attacking both allies and rival countries alike, and buried in I think it was Section 299 of the new tax bill that's been passed by House of Representatives and now discussed in Senate. There are proposed new taxes on foreign investment. If you're a foreign investor buying U.S. bonds or stocks, you might be subject to much higher taxes. So for all those reasons, foreign investors are starting to back away from the U.S. dollar. The U.S. dollar is down about 8% this year. And that, of course, makes U.S. bonds less attractive. So that's all happening. Now, what happens when the U.S. bond yields rise? Well, you mentioned that means the value of the bonds go down, and that's true. Also, mortgage and corporate loans become more expensive, and that can hurt the economy. The interest expense that the government pays as a percent of the whole budget now rises, requiring even more borrowing. So it's kind of a vicious cycle. And then, of course, the present value of stocks' future earning streams go down because the discount rate is going higher, and that hurts stock prices.
That's a tough environment. So thank you. Now we have a better understanding of the recent activity. So let's look ahead. And why don't we do what we often do, which is perhaps you could lay out two opposing scenarios and describe okay, what could happen in the realm of public policy, the economy, or the markets that could be helpful to bonds and maybe bring these interest rates down? And, or conversely, what could happen to exacerbate the pressure on the bond market from here?
So if the tariffs just went away, and if the final U.S. budget that gets passed showed more control over the government debt and deficit problem, that would bring inflationary pressures down. Foreign investors might be more comfortable holding U.S. dollars and U.S. dollar-based debt, like government bonds. And that would be very supportive, and yields could come down. Also, not such a good scenario, but if we ended up going into a recession and it was deflationary, not inflationary, that's always good for longer-term government bonds. It wouldn't be good for longer-term corporate bonds because people would be worried about recession, default risk, but it'd be good for government bonds. So those are a couple of scenarios, one better than the other, that might help. Now, on the other side, let's say that the inflation from the tariffs starts showing up in the hard data. That's a problem. Let's say that the final U.S. budget that comes out of the Senate, that ends up coming out of Congress, is projected to add trillions to the government debt, which the current version seems to be projecting right now. And let's say that foreigners continue to shy away from buying U.S. bonds and dollars because of all the reasons I mentioned in the last question. Then we have this problem where the supply of U.S. bonds is increasing because the debt is expanding and demand is getting less and less. And so interest rates have to go up and rise until it finds more demand. And then you get a vicious cycle of more borrowing just to cover the rise in the interest payments to fund the existing debt. So that's a problem. There's one other problem. You mentioned this is not just U.S. but global. Japan, for the first time in literally decades, is seeing a big rise in their long-term bond market yields. And this is a new development. And for years, Japan has been our biggest creditor, or the biggest lender into the U.S. government bond market, lending us money that we need to help pay our debt. If all of a sudden the equation changes, and instead of making more money by lending to the U.S. because they get a higher interest rate and they get currency appreciation, all these good things, all of a sudden we reach a critical point where the interest rate difference isn't so much because the Japanese bond yields are going up now, and it costs more and more to hedge the currency risk because the dollar's going down, not up. They might decide that it's time to repatriate all the money that they're putting in the U.S. bond market back into the Japanese market. That would be a big development that would hurt both our bonds and our stocks.
Wow, this makes me feel very old, but I remember a period, I think it was back in the 80s, and the conversation over and over again was, were the Japanese going to step up and buy the next U.S. Treasury auction or not? So we're back to the future, I guess. So as always, my final question is based on what we've discussed here, about the different scenarios and all the, possible iterations between. What might investors do with their own portfolios to be best prepared for whatever may come our way?
So unlike most Wall Street analysts, we've been advocating reducing allocations to longer-term bonds, and that has been the correct action to take since the summer of 2020 when the great bull market in bonds peaked. So instead, we rely on shorter-term Treasury bills, on TIPS, which are Treasury inflation-protected securities, and on gold as hedges to equities. Now, given the overvaluation U.S. stock market, we're not surprised to see that this year, for the first time in a long time, international stocks have been outperforming U.S. stocks this year, and by quite a bit. And we also have noticed that emerging market stocks are particularly relatively undervalued compared to other markets. So this is what we're watching. Having said all that, there's still potential for the bubble in U.S. stocks to continue to expand because there's still so much of this buy the dip FOMO, which is fear of missing out mentality that exists in the U.S. market. So we have to be aware that there could still be more bubble expansion before the U.S. market corrects. So those are really the issues that we're looking at and why we think it's more important than ever to stay diversified.
Perfect. Thank you. Good. Thanks, Steve. I think what jumps out at me here is just how much the economic landscape has changed. So for so many years, interest rates were so low that an increase in the debt, didn't seem to really have any impact. But I think those days may be behind us. But one thing that is certain is that here at 3Edge, global multi-asset investment firm, we'll keep a close eye on the developments in the bond market, not only here, but globally, and continue to seek to generate attractive risk-adjusted returns on behalf of our clients, regardless of the environment we find ourselves in. So that will do it for Steve and for me this week. As a reminder, all our videos are always available on our 3Edge YouTube channel. If you know someone who might benefit from them, please feel free to share them. And on behalf of Steve and everyone here at 3Edge, thanks for listening.